Welcome back to the What You're More podcast. Today I'm joined with one of my co-hosts, Mr. Daniel Halverson from Bank of England. Thanks for joining us today for this much anticipated lending update as we kick off the 75th episode of What You're One More.
Yeah, man, I had to get my hair cut before this. You're big time now, so.
Yeah, you went and got your wig split there for us today, man.
Make
Much
sure
appreciated.
I'm acceptable for this.
Yeah, man, we got a lot to discuss here today. We've kind of been building up and leading to this in the episodes before this, a little bit with Dan Habib, a little bit with some of the student loan debt information that we talked about, and then we did a week in review. But, as I mentioned in all those, this lending update is going to compile all of that, but also bring to light some other things. And, one of the conversations you and I've had over the last couple of weeks is, describing customers and describing like the mindset or maybe where they are in their decision-making process. And folks, don't get it twisted. Today, the CPI came out, and it was very favorable. We're seeing tremendous market movement from that. And this could be the beginning of something that we think could be a catalyst to an even more competitive environment, because right now we're already seeing tons of applications and we're seeing lots of credit pulls in the industry. We're just not seeing maybe the purchase contract connect with that borrower. But we are recognizing there's three types of borrowers that are out there. Daniel, you want to kind of tell us about which borrower are you, man? Like which borrower are our listeners? Kind of describe what we're seeing out there.
Yeah, this was kind of an observation of just multiple conversations, but we're kind of finding ourselves in a scenario right now where there's confusion around the economy, right? Inflation, there's recession talk. There's some people in some areas of the job market that are hurting. Consumer spending, we've talked about that. People are burning through their savings. But the one thing that existing homeowners have that's working for them is their house, right?
Correct.
And the challenge with that, though, is a lot of those folks want to access their equity or do something with the equity they've got in their house. So there's really people I'm finding are really in one of three categories. They've outgrown their home, or they have some other reason they'd like to buy a new house.
Okay.
But they feel like they can't do that because their mortgage rate on their current home is so low. Second set of people is they want to access their equity for something. They want to renovate their home. They want to consolidate debt. Maybe they want to do something, invest in something else. But once again, they feel like, hey, I don't know how to do this because I've got a 3% or 2-something interest rate right now.
Yeah, they're kind of locked into that rate.
Correct. And then the third subset of people is they would consider cashing out their equity and selling, and they feel like, hey, maybe we're at the top of the market. Maybe I want to do that. Mm-hmm. So really the question becomes, where are those people? When you're having those conversations, what grouping do they find themselves in? And this is something that's really geared towards people, obviously, that own a home right now. But what I'm finding is there's a lot of people out there that have decided, for whatever reason, that they want to wait from doing any of those things. And when a customer calls and says, hey, listen, now's not the right time. I know we've talked. I'm not interested in moving forward right now. I think that the natural response for people that are looking out for their customers is, well, hey, I understand. Let me know when it's time. Mm-hmm. And for some people, it's not time. But I think that the question that should be asked is, well, what's going to change?
Right.
Right. And I don't think that it's not intentional, but I think both people in the mortgage industry and the real estate profession alike, they don't take the time to just ask, well, what's going to change? Why do you feel that way? And how are future circumstances going to get you to a point where this is possible, right?
Right.
So if I want to go buy a new house, but I feel trapped because of my interest rate, what's going to change in a year if interest rates come down? Home prices are going to go up, right? So you pay more for that house in the future.
How hard is it to get a borrower to understand that? Like the rates come down, home prices go up. Like how easy is it to get that concept conveyed?
Well, that's the hardest thing that you could possibly convey to a customer. And you can provide them with real-time data, but there's this notion of, well, I'm going to catch it before everybody else does. Mm-hmm. Or, yeah, that's fine, but your home price appreciation forecast is hypothetical, right? Mm. That's the hardest thing to really convey to somebody. And there's a lot of if this, then this involved in that. And I think people are biased to see the good in the situation of, well, now interest rates will be more affordable. But they don't necessarily see the bad part of that. What could happen if interest rates go down is this. So that is a big challenge, and then people that want to access their equity. I think that a lot of times somebody calls, maybe they want to do a refi. They have interest, and then they get a quote from a lender and say, well, this rate's too high, right? I'm not going to do this. And nobody takes the extra step to say, okay, well, let's talk about what we're going to accomplish with this refinance. Mm-hmm. Do you have other debt that we're going to eliminate? And the other day, I had somebody to rattle off some statistics. Average home equity loan rates over 8.5%. Credit cards are 21% right now.
Right.
Used cars are 12.5%. New cars are 7%. Unsecured loans are 12 to 13%. And buy now, pay later loans are 21 to 23%.
I mean, think about those numbers, man.
So,
that is just asinine, man.
So people get locked into this. Well, my new payment is this. My new interest rate is this. And for some people, maybe it doesn't make sense to refi. If you need $20,000 and you got a $400,000 loan at 2.5%, sure, that's not something that you should consider. There's got to be another way to get what you need out of that from other financing products, right? But the challenge is that nobody's taking the extra step to say, hey, how do we, what are we accomplishing with this? Are we getting rid of other interest? Is anybody looking at my total blended debt ratio, or am I just looking and trying to compare 7 to 3 and saying, well, that doesn't make sense? And for the real estate agents out there, I realize that's a refi-driven conversation, but at the same time, a lot of times people refinance to position themselves for something in the future. So it is beneficial to put your clients in a situation where they can refi and accomplish some of those goals. But the other thing is, hey, I want to sell and buy a new house, but maybe I'm 6 months out, I'm 12 months out. And we've had the conversation, maybe hypothetically, we've had the conversation with the client of what's going to change. And we've talked through that. And maybe they are, for one reason or another, maybe it makes sense to wait, right? Mm-hmm. But is anybody putting me in a position with an equity transition plan where I can go from house A to house B and line myself up in the best possible scenario to do that? Is anybody talking with me about, should I put more money down? Should I put money into savings? Do I have all of my net worth in my home, right?
Right.
Should I pay off other debt? Nobody's taken the time to really line these things up so that people feel like they've got a plan. And then when people feel like they've got a plan, they're more likely to do something. So
sure.
The big reason that this is in here is because I think that these 3 scenarios really resonate with a lot of the lenders and real estate agents and people in the financial professions that maybe are listening to this. So these conversations really resonate, and it becomes a matter of, can we put strategies together to give people a plan and give them some real information and not just surface level, here's where interest rates are. And, I think that if we took the time to ask more questions, well, what's going to change, right? And off the topic here, but if you've somebody that doesn't own a home and you say you're going to wait, and the answer to what's going to change is anything other than I'm expecting to make a lot more money in the future, or I'm expecting a lot of money to be coming to me through some other means in the future. Those are really the only acceptable answers to say, okay, well, it probably makes sense for you to wait, right? Because all the other excuses are not going to work in your favor. Well, I want prices to come down. I want rates to come down. All of these other hope and wish things are not acceptable answers to now's not a good time for me.
Yeah, and to your point of all those interest rates you described, I mean, that's a lot of interest. I mean, I heard 7 was one of the lower ones there. But, we often talk about in some of our shows, like, well, where would you put your money right now? Is it in a money market fund? Is it there? If you've got equity, like, you could instantly pay yourself any of those interest rates by paying that off. And it doesn't matter if you're getting a mortgage rate that's higher than what you currently have. It's lower than those other ones you described, which are also not tax deductible. So, I mean, there's a lot of benefits into looking into that. And I think you just raised a lot of great points there. The other one I kind of wanted to circle back on, though, was when we hear about buyers that are, hey, I want to wait till rates come down, or I want to wait until home prices come down. I think there's a lot of people that are programmed by social media, and you can see tons of clips where people are, this is me waiting on home prices to be what they were back in 2009, and there's, or hey, there's going to be a foreclosure wave, there's going to be a short sale wave. And, in one of our previous episodes, I think it was like 2 episodes, we broke down why that's not going to happen. Like, it's not even wishful thinking. It's not going to happen because of the equity position that everyone's in that you described, and plus the demand. What do you tell? What are you telling people that are going? Are you still getting people that are saying I want to wait, or are they a little bit more? I don't like the word. I'm not a fan of this one, but are they a little settling into the current environment right now? Are they a little more adaptive to go? All right, I get it. Let's move on.
Well, I think a prime example of settling in is last week. The week of July 7th. Or what is that? The week of July 3rd to the 7th.
Yep.
interest rates went up probably 3/8 of a point, and mortgage applications for purchases were up.
Yeah.
So, and granted, maybe that doesn't all cycle through the system quite that fast, but interest rates make a move up like that, and mortgage applications for purchase loans go up. So I think that there's a lot of people at this point that are understanding that the interest rate environment is what it is, and there's still this upside. I think very educated people still realize there's some upside in the future, but to sit and wait on that to happen, probably maybe not the best scenario for a lot of people.
Well, we just recently sat on a call, or I guess you could say a webinar with Brian Buffini on his mid-year update and David Stearns, and he said customers are experiencing three things right now, and I think it kind of goes with what you just described. Fear. The news and social media has got them so fearful that the fear of missing out, FOMO, if you may, my friend's got a deal. Why don't I have a deal? They've got what I want. Why don't I have it? And the third one was insecurity because of comparison, and I think that kind of goes with that settling in that's starting to happen. Is to eliminate all three of those. The next step is to move forward. And that's probably what we're starting to see. And the closer we get to the end of the year, the closer we get to the tax season being complete, there's a lot of people that are just tired of wasting money on rent. I mean, they're making good money, but yet they're not receiving any tax benefit by paying rent.
Yeah, in that same Buffini thing, I think he said 3 million renters making $150,000 or more annually.
Yeah, that's a pretty absurd number.
So,
and
obviously
absurd number when you
market
think about
specific, right? If
Sure.
you're in San Francisco, your income's going to be higher, and your rental prices are also going to be higher.
Right.
But 3 million, they're not all concentrated in high cost areas, right?
That's correct. And I think the point he was trying to drive home is there's people making good money, affordable money to buy a house versus just renting, right? And some would argue, hey, listen, there's just the inventory's not there. I agree, we are seeing inventory issues, but I'll also agree this: it's inventory issues based on what you want versus what's available, right? And so, we've talked about this too. It's also not a bad idea to buy a property now, knowing it's not your forever home, but you're seeing values go up. You could do that equity transition you talked about. I love that term. Never heard that before. It's fantastic. You could do that equity transition plan. Go ahead and put it together. Go, I'm going to buy now, and a year from now, we know rates are going to decline. I'm going to take advantage of that by transitioning that equity into the home that I do want. That might become available in the market, right?
100%.
Because last time I checked, the inventory across the country is not at zero. So someone can't tell me there's no inventory. There's tons of inventory. It's just not necessarily what you want right now, because you got to understand you're not buying your forever home right now.
Right. And the reality is when inventory is this tight, all you're looking for is one property. If I'm buying a house, all I need to find is one property to buy, right? So if I'm not in the game, then I'm probably not going to be in a position to move forward on that one property.
That's correct.
You can't find what you're not looking for.
Yeah.
So.
And then, there's battling the investors that are out there too. And, another popular trend that we're seeing come about for investors is down payment solutions for investors. I thought I would never see this situation, but talk to us about this down payment for investor solution.
Well, there's two things here, and one of them is really just kind of a little known thing. But and when I look at this down payment solution section, what I am often referring to is, sometimes you got somebody that wants to buy an investment property, and maybe it's a husband and wife, and it doesn't make sense to have one of them on the loan for one reason or another, but they are the ones that have the funds available. Mm-hmm. And traditionally on investment properties, the answer that most people give is, well, you can't have gift funds on an investment property.
We've heard that for years.
Which is true with Fannie Mae and Freddie Mac, but they do allow for specific guidelines for non-borrowing purchasers to contribute funds.
Okay.
They have to be on title. There's some other caveats. If somebody has specific questions about this, any good lender or obviously our team at Bank of England would be happy to give them some details on that. But it's something that's kind of very, it's not talked about a lot, but it is something that's out there. And it's a situation where, like I said, maybe a husband and wife situation, or, maybe there's multiple individuals. You got one person that's going on the loan because they're well qualified, and then they're buying with a partner who is the money guy or the money gal. So there's situations where that can make sense, where you can move forward with an investment purchase, not have to treat it as gift funds.
Yeah.
And then on the flip side of that, for the rare situation where somebody wants to buy an investment property and they are indeed getting gift funds, we do have non-traditional, non-agency products for something like that. So we do have solutions for investors that maybe it's a situation where a parent wants to help you to purchase some property and start building a portfolio, and they're going to be gifting the funds. We do have solutions for that scenario as well, which is something that's relatively new, and it's something that we run into probably a good bit more than you would think with investment properties. And sometimes maybe it's not truly an investment property, but the way we're having to classify it on the loan, it's kind of boxing it in there. So there's a lot of scenarios where either of these solutions could make a lot of sense.
Yeah. So if I understand correctly, if you're doing a traditional, Fannie Freddie loan, as long as the person is not a non-borrowing, they're just on title, that person can contribute funds to the closing.
Correct.
Yeah,
yes.
that's a big win. That's a big win. Little known fact there, big win. So here's a maybe not so big win, but definitely worth talking about. And and I do want to preface that this law took effect July 1st here in Florida specifically, and there's other states that have jumped on top of this and are doing the same. There's a documentary right now on Netflix about a little bit about why this law came about. And it's ironic that dropped the same time this law did, but specifically about some stuff that's taking place in Michigan and some areas that are being bought up by some of these countries that we're getting ready to mention here. And so, but I did want to give this caveat. There is an injunction on July 18th that's set to take place that two foreign nationals sued from South Florida, the state of Florida, to kind of try to prevent this law. I don't know that they're going to win. I don't know what the outcome of that is, but what I do know is what we're going to talk about is true as of right now. So I did want to kind of preface that. July 18th, this could change. It could not change. It could modify. Who knows? But as of right now, that's where we are on this. So let's talk a little bit about this Florida, purchase reform, I guess is what we would call it.
Well, if this changes before somebody listens to this, then we'll just call this a spirited conversation.
Fair enough.
But what he's referring to is essentially a bill was passed in Florida that restricts certain non-U.S. citizens, so foreigners from certain countries, from purchasing property within certain parameters.
Regardless of work visa, regardless of any of that.
Correct. So basically, if you're a non-citizen, I think there were some exceptions for if you're a permanent resident as well. But I read a bunch, did a bunch of research on this. I even tried to read the bill, and God bless anybody that has to write those or read
128
those.
pages.
That was rough. But so I got some conflicting information. But essentially, the gist of it was these certain countries, and we'll have this in the show notes. But basically, cannot buy any agricultural land. Or have majority ownership in agricultural land. Meaning
farmland, anything of that nature.
Correct.
That's greater than really 3 acres on a purchase of a residence.
And it's also restricting people from those countries from purchasing a home within 10 miles of an airport, a military installation, or other critical infrastructure facilities.
Super vague.
And it wasn't well defined what a critical infrastructure facility is. And I also saw something, I don't know how true this is, but it may be actually within 1 mile of a military installation.
Yep.
And that wasn't expressly in a spot where I could quickly get that answer. But I just think the big reason I put this in there is, one, I had no idea. One of our guys mentioned it a few weeks back, and I was like, what are you talking about?
Well, he actually had a deal that he had to postpone because of this. And I mean, the 7 countries are, the bans are, they're all either dictator ran or they're communistic countries. It's Cuba, Venezuela, Iran, Russia, China, North Korea, Syria, and that pretty much is the deal that he was referring to was a person from Venezuela that was on an L1 visa, tried to purchase a property with a close date of July 5th and was told couldn't do it because it was in a certain mileage of those areas you just described.
Yep.
And the interesting thing there is that infrastructure facility, critical infrastructure facility. There's a lot of rumors swirling around what that means. Everything from a transformer for your utilities to critical infrastructure could be a bridge that goes over the water. I mean, there's a lot of vagueness on that and what it means from that area. So it's pretty nuts that that's just out there. But I think we're gonna get some clarity on it after the 18th.
Yeah, I mean, and I think that the big question is, who's responsible for oversight of this, right? Are we putting that on real estate agents who already have to be very pointed in the questions that they can and can't ask, the advice they can and can't give? Are we asking real estate agents to be national security agents too? Is this a lender thing? I mean, there are sections where we verify, ethnicities.
Yeah, but none of those boxes are available to check.
Right, and then, or are we putting all that on real estate attorneys? So it's kind of this interesting dynamic of like, who's going to do this? There's also no map I can go to and say, 123 Main Street. Does this qualify or does this not qualify?
Correct.
Where are these things located? Right? Are we now required to read maps for anybody that we show a house to, as a real estate agent? So it's an interesting thing, and I always find it. I wouldn't say this isn't humorous, but I always find it interesting that they pass a bill like this, and there's no real guidance. They don't have any of these resources. They don't have everything together. They just say this is how it's going to be, and until we figure it out, everybody can just scramble around and try to speak intelligently about it.
Well, yeah, I mean, it's obvious this is politically charged, right? You can see it in the writing here, whether you agree with it or not. I think we can all agree it's politically charged, but it's my understanding that it's the title attorney's responsibility, because to your point, real estate agents cannot ask some of these questions. We can't ask some of these questions as lenders, so it's definitely going to fall on the title agent and a title attorney. And as I was speaking with one before the show, he said, there's an affidavit they're going to sign, and they have a plan they do have a plan. Now the question is, how do you monitor that map, right?
Well, hopefully that affidavit's not being signed at the closing table. Yeah. Might have some disappointed people.
Yeah. Well, I think that's as I chuckle and kind of laugh about that, the reality is, I think that in certain areas of Florida, you have a higher concentration of those particular nationalities versus in other parts of Florida. So I think it'll be I think in certain areas this is going to be a lot more encumbersome than it is in other areas of Florida. But till then, July 18th, I could just get tied up further. Who knows? But the thing becomes the reality is, some of those nationalities come here on an L1 work visa. And for those that are familiar with what that is, that's the company you work for. Let's use General Electric, for example, because they have a huge facility here in Jacksonville. It's not uncommon for them to bring people from other countries over here to do specific work. And the L1 visa allows them to work for 2 years. The company files their taxes for them based on the W-2, so they're paying taxes to the United States. They have the ability to go back and forth multiple times with that L1 visa. And I mean, they're not a citizen, but they do provide a job that's being done here in the United States. And so I think the challenge behind this law is it prevents that type of workforce from coming over here. And I use GE as a specific example because I know for a fact they do have people come from some of those countries over here and work and do jobs. So I think that's I think from an employer-employee standpoint and a labor force standpoint, that could be a critical component that comes from this.
Yeah, and just like every law, right? There's probably some merit to it for certain scenarios, and then there's unfortunately a subset of people that get punished that are on the wrong side of this, and hopefully they can resolve that in a way where it can be majority a win. But for me, it was more the interesting conundrum of, well, who's going to regulate this, right? How's this going to be done? In
a continued conversation with that attorney, he said that if you currently own a home, and you're of one of those nationalities and you own it, you got it before July 1st, you just have to submit
to register,
and then put on notice with the state, and life's good. However, if you inherited that property from someone, within 3 years you're forced to sell it.
Wow.
If you paid cash for that home and it transferred, you're going to be forced to sell it. So there's a couple of definitely, you could see why people are in uproars, because every loophole you can think of, they've got. It doesn't really benefit you, is what I'm trying to say. It doesn't benefit any of those nationalities. So it was a pretty harsh. You said there might be some merit behind it, or who knows. But like you said, there's always some people that get caught up in that and get punished for something that isn't necessary. So speaking of unnecessary, let's talk about this. 1 step forward, 2 steps back. And quite frankly, for me, this one's kind of humorous, because here today we just had a major inflationary reading come out that was very favorable, and we're seeing a win in the bond market. But prior to that, this whole lending update was kind of scripted prior to that, so we're going to modify it on the fly a little bit here. So I'll let you kind of take this one, and then we'll kind of chime in here with updates that we have.
Yeah, I was joking with you. I think you just basically did the lending update last week with another Dan. For those of you that haven't listened to the one with Dan Habib, I mean, he's the expert here.
Check out episode 72. He crushed it.
I'd be lucky to hold his lunch pail and talking about this stuff. But but I guess first and foremost, let's talk about June, right? Because the update that came out was for June's data, and what was interesting is June brought favorable news on inflation. Interest rates not so much, but the mortgage rates pushed back into the 7s.
Right.
Just a few months ago we were pushing low 6s and feeling like, hey, our predictions are coming to fruition, although slower than we were hoping.
Sure.
And then all of a sudden, now we're back into the 7s. What's going on here, right? And in the month of June, headline CPI came in at 0.1%. And inflation went from high 4s, 4.9 to 4. So you got a 20% reduction in inflation, but you got mortgage rates going up. So why is that? Even more so now you've got year over year, June to June, you went from 9.1% transitory inflation, right, to 4% inflation.
Right.
And I say transitory jokingly for those
right.
of you that haven't lived here for the last 12 months. But the big thing with the markets is, and we've talked about, unfortunately the Fed changes what they care about data-wise and inflation-wise every so often. But the big challenge with seeing rates improve over the last few months has been, yes, you're getting these big headline moves in inflation, but the core inflation is not moving as quickly to the downside as they're hoping for.
Correct.
Which means energy prices are down about 20%. So maybe that's driving a lot of these headline inflation. So core inflation has been a little bit more stubborn, right? And it moved from 5.5 to 5.3%. So it came down. We'll talk about July here shortly, but it came down, but we're not seeing it move as quickly, right? We're at 4% on the headline, and we're at 5.3 on the core, and the Fed's here saying, okay, well, the core is what we feel like we have more influence over, so our policy must not be working, right? So, you saw interest rates go up. You didn't see the reduction you would be hoping for in interest rates with inflation because the core rate has been a little stickier, a little more stubborn on the downside. But the other component here that has continued to kind of be a challenge is we're not seeing the weakness in the job market to the extent that we thought that we might be at this point.
I don't think we know what we're seeing in the job market personally.
Well, and that's if you follow these reports, or if you're a CNBC or a Yahoo Finance headline reader, you probably saw what ADP said, 497,000 jobs created, right? And that moved the market considerably to the downside. Rates went up in a way that we haven't seen in a very long time in a one trading day.
On a jobs report that has been, quote unquote, restructured, put back together as of September of 22.
Yep.
So we've had a history before that of consistent job reporting as far as how the metrics were determined. But on September 22, ADP said, you know what, we need to get it better, or we need more accurate numbers, openly admitting what they had was not accurate, which is kind of humorous because what we're getting right now from them is pretty audacious numbers that aren't even in comparison to the BLS, and there's massive revisions that follow after that.
Yep. So, so basically there's two job reports. There's ADP, which is private workforce data, right? ADP is the largest employer payroll service provider in the country.
Hands down.
So they do their own report, and they don't have all the job data. So they take the sample that they have and extrapolate that out across the entire country. So they say, well, we have this percentage of data, of jobs, of payroll. So we're just going to assume our sample size is accurate, and we're going to extrapolate that out, assuming that everybody else has the same data.
Correct.
So they came out with 497,000 jobs.
Created.
And then, the Bureau of Labor Statistics was a little bit over 200,000 jobs. And the BLS report is the one that is generally more weight's put on that.
Sure.
But like you said, ADP basically took their job report, took it offline, said, hey, we're not really sure this is right. And then they came back, and since it's been back, it's wildly different than the BLS report. So then it becomes, well, who's right? Where is this coming from? Who authorized changing this algorithm? Right. Seasonal adjustments. Who knows what's going on? But it's way off. So, but the big thing is with the job report, the unemployment rate went from 3.4 to 3.7 in May. Then it went from 3.7 to 3.6 in June.
Right.
So we're not seeing, unemployment is still kind of holding in that range. Initial jobless claims, they're not moving up considerably higher. We're seeing wage pressure decrease in the sense that, ultimately wages are still up on a year-over-year basis, but growth of wages has been coming down slowly. It's just it's not happening quickly, but it's happening little by little. You went from 13% year over year to 12 to 11 to 10. So it's starting to come down. I think BLS, it's more somewhere in the 6s or 7s, the year over year wage growth.
Right.
So you're seeing wages go up, but slower. And then if you really dive into these job reports, you start to see, well, a lot of these are part-time jobs.
There you go.
A lot of these are people taking supplemental jobs. And those jobs are still here in abundance right now.
But those also could be argued part-time is temporary normally. It's not permanent.
Right.
I mean, you're adding that job to supplement your cost of living, which is being driven by inflation and some of that wage growth you described, or employers maybe cutting back, who knows, but you're having to get that to supplement. That's what that is.
Correct. Yeah. And I would argue that you're probably seeing a lot more softness in the labor market for higher profile jobs at this point.
Mm-hmm.
You know, I'm a high level employee, maybe I'm a manager, an executive. You know, I think those jobs we're seeing more softening, but there's still an abundance of more entry level jobs or part-time jobs. So, and it's just taking longer for that to filter through. And, you know, I don't think there's enough patience on the Fed's end of saying, well, everything continues to go down, so let's just let it continue to go down, right? There's no reason necessarily to talk about continuing to hike interest rates if things are improving. Why don't you just let them improve? And if they stop improving, then you still have that ace in the hole, right?
Yeah, and I kind of want to bring up something here, and I'm probably going to say something that's going to get picked on later on. But in our YouTube channel, you know, and check us out on our YouTube channel, subscribe. But we have some comments on an episode where you and I started to talk about this, and man, people were like, we suggested that, you know, day one on the job doesn't mean you're going to be the CEO after 2 years. But there was this pushback. It's hard because we talked about, you know, earning your right to get to that level, putting in your time, maybe taking on a extra responsibility, right? The way that was taken on online, there's a plethora of comments. People just outwardly upset at CEOs, big companies, basically using their people to get more production to make bigger profits. And their thought process was, well, if I'm going to do that, I need to get paid more because you're making more profit and I deserve the right to that. And to me, I was kind of taken back by some of the ideologies of people because, you know, I don't know what companies those people work for, right? But I'm not saying like you're doing two jobs and getting paid for the price of one. I'm suggesting that, you know, taking on more responsibility thus shows a sense of leadership, not necessarily, you know, double dipping the workforce. But it was interesting, some of the mindsets. And I guess what I gathered from that was a lot of people feel beat down by their companies. A lot of people feel manipulated and used by their companies right now. And, you know, it's almost like that's why you see people shifting jobs, if you may, because they're unsatisfied with the way they're being treated or being paid for what they're doing. So they're jumping ships. And you know, I think there's statistics that show there's like an incremental increase when you switch jobs.
Job hoppers versus job stayers.
Yeah, exactly. So I just thought that was interesting because, man, boy, we had some fired up people that just immediately just took to that and was like, you know, if I'm going to do this, I should get paid for it because the company's making more. And I mean, the flip side of that coin was, well, the company may be trying to survive. Like, how do you know did you see the P&L? Have you looked at the numbers? Like, what do you know what do you know? Like, what do you know? And the answer is you probably don't. You're assuming that, right? And you're holding a stance, and the company may not be able to pay you for that because the company might be holding on by a thread.
Right.
You just don't know.
Well, I think everybody wants to be paid more, right? So that's probably part of it. And that's obviously, we want people to be paid more.
Sure.
But yeah, the reality is more people want to be paid more. But, you know, if you work for a publicly traded company, look at your earnings reports. I mean, there's a handful of stocks carrying this little rally that we're seeing in the stock market. It is not an overall abundance of strength. And if you're in just an index of the S&P, you're probably not doing so hot right now. If you're not concentrated in the stocks that are outperforming the market, you're not seeing returns. So if these companies' earnings reports were through the roof, then you would see that. And then maybe
a lot of argument. This rallies from the AI, you know, era that we're jumping
very
into
much
right
so.
now.
Yeah.
You know, that's where a lot of the boom's coming in the Nasdaq. But you know, so that we don't get off track here, let's come back to the CPI has actually come out this morning.
Yeah, breaking news.
Breaking news
today, guys.
We had a great reading this morning, which we anticipated coming. There was a lot of things in there that we anticipated coming down that did. Obviously, shelter costs. You've heard us talk about that over and over again. Still kind of rearing its ugly head here. But even with that, we had a significant drop today on the headline and on the core.
Yeah, big time. So we went from 4% to 3% on the headline. So a 25% reduction for those of you following along at home. And then the core, 5.3 to 4.8. So
big time.
That's a big move.
So you've got the CPI core at 4.8 and the PCE core at 4.6. So they're very much in line right now. Even though they measure things differently, the fact is they're in line. If I'm the Federal Reserve, I've got to take a step back and go, wait a minute. I'm starting to see some things happen now. We've had a tremendous amount of rate hikes. We've gone from 9 to 4.8 and 4.6. It's working.
Well, and think about this. 70% of the increase in core inflation was shelter costs,
Yep.
which we know are coming down.
Yes.
And we have crested. They are coming down. So, and we've talked about it. I realize if you follow along in this show, you're probably like, yeah, but when's that going to actually happen, right?
Well, we got to cycle through those 12 months.
We're starting to see it. If you look at the charts, you saw a straight line up. You saw a little bit of an evening out on the curve, and now it's coming to the downside ever so slightly, right?
Yep.
But that's encouraging if 70% of your increase was shelter, and you know that shelter costs are down considerably. Well, that would probably lead you to believe that the months ahead are going to be favorable, which is why the smart money, every worthwhile economist that I have seen talk about interest rates all say lower by Q4, even lower than that by the following year.
Correct.
And those people are significantly smarter than I'll ever claim to be. But if you're starting to see it from everyone, well, they're probably not just making that up. These are the folks that get into these reports. Actually open them up, right? Don't just read the headline. Actually open them up, see what's in there, see what's happening, look at the trends, and then you look at somebody like Dan and Barry Habib. I mean, these guys are forecasting where inflation's going to be before the report comes out, and they nailed it. They nailed it today. So they're not just making this up and hoping and praying. They have actually in a large part figured out, based on what they can see, where these reports are going to land. And I think this is speculative on my end, but I think that's why you saw the rally really start on Monday. Market improved Monday, market improved Tuesday. Now today, big improvement in interest rates, which offset a lot of the bad news that we saw in June. I mean, with a little bit of a run here, we could be coming back to rates that we saw in March and April that were a lot more favorable.
Yeah.
Now, are we headed to 5% tomorrow? Absolutely not. But we're erasing a lot of the rates going up that we saw over the last 4 to 6 weeks.
Yeah, the light's at the end of the tunnel, the writing's on the wall, whatever you want to say, people can see it. And the other thing is this: I think that now the Federal Reserve is going to have to make a decision, right? And all bets are on a quarter hike here on the 25th and 26th of this month. I still don't know that's going to happen, but I will tell you this: the Federal Reserve's policy has been a tightening policy over the course of the last say 12 meetings. And inside that tightening policy, you described it earlier in the broadcast, and I kind of want to point it out here. Credit card, 21%. Used car rates, 12%. Home equity lines, 8.5%. Guys, that is tightening of the credit policy. It is there to deter more spending and less money making its way into the system. And so another reason why in this CPI reading, the car sales were down. Well, they're down because it's 12% interest rate, and new cars are at 7.5%, you said. They're down because the tightening policy of making it more expensive to buy an item is the goal. That's one of the major goals. And so it's working. That's kind of what I want to point out. It's working. And the Federal Reserve they're not going to be naive to that, right? And I think Dan even made it a point to say, hey, listen, the target rate at 2% is a number that was discussed behind closed doors, between Janet Yellen and Greenspan. And it should have never made its way out. The stories have gone on. We've heard it multiple times. It should have never made its way out. And somehow it did, and now it's been adopted as their target rate. But a target rate and a comfortable rate are going to be two different things. And as we've discovered, 3.3, 3.5 might be the number. 3.3, 3.5, and we're pretty damn close to that number. And I think this whole ideology of raising a quarter, 3 more times in the system, I just don't see it happening.
Well, and let's talk about real interest rates for a minute here. So, June of last year, you've got, you got inflation at 9%, federal funds rate. They just started to tick that up. But for all intents and purposes, at one point you had 6, 7, 8% inflation and 0% interest rates on the Feds.
Correct.
Now you've got 5 to 5.25
Yep.
on the Fed funds rate, and no matter what inflation you want to look at, you want to look at headline, it's 3%. You want to look at core, it's 4.8. You got positive real interest rates now
for the first time.
So you've gotten to that point, and you haven't even given it a month to see how things go. So it sounds like the 25 basis points is a foregone conclusion. Unfortunately, we can't get Jerome Powell to return our call to be on our show. But, I mean, how could it be a foregone conclusion? And it sounds like you're going to get more. The producer price index is coming out soon. It sounds like you're going to get a further reduction in producer prices, meaning that they're not, the cost of the components are not going up very much, if at all. So why would you not look at this and say, well, it's not like we are, by saying we're not going to raise it, we are eliminating the possibility that we can do that
Right.
in the future if new information presents itself.
Man,
But
the only thing lagging here is the employment numbers. That's the only piece of this puzzle that's missing. Because I promise you, if those employment numbers, if unemployment was up in the fours, right? Let's just say 4.1, and those ADP numbers were showing 100,000 growth, and BLS was showing 100,000, you'd have this finite, like, okay, the whole ecosystem is doing what we want it to do right now. The challenge is that those numbers, call it what it is, manipulated, not miscalculated, so new we don't know what to look at, or they don't know how to have a proper barometer of calculations. It is what it is. But the reality is that's the only missing piece to the puzzle of their entire agenda that they're trying to accomplish. And so remove that out because it's really kind of hard to look at. We're right there. We're right there. So I don't see this 3 additional hikes taking place the rest of the year. I'm not buying into that. I know Jerome Powell said that, but I also know he has said a lot of things. I know he said that, 18 months ago that we need inflation. We need a lot of inflation, and we got it.
He also said we had a housing bubble at one point.
He also said we had a housing bubble. I mean, the list goes on and on and on. So I'm not buying into this.
Can't say the B word unless you know.
Well, and the reality is, well, what do you expect him to say? He's not trying to send a smoke signal to investors of what's going on to manipulate the markets. He's trying to, set the tone, but he's not going to show his hand. And so the reality is, you've got Mr. Bostic of the Atlantic Federal Reserve, who is a voting member on the FOMC. I mean, as of yesterday, came out and said, we no longer need to hike. So there's a voting member that just said, we do not need to hike. We need to shut it down and let this run through the process. It'll be interesting to see, and other Fed open market committee members, they'll all come out. There's quite a few that like to talk. He's one of them. They'll all come out and say their piece here. But the reality is, I think that, I'm going to go back to what I said probably 3 weeks ago. I think that might be the pause heard around the world.
Well, let's hope they read this report before they meet in July.
Yeah, I'm sure they will. I'm sure they will, Dan. Well, hey, as always, man, thanks for being on the show. Always bringing great value, great content. I can't thank you guys enough over there at Bank of England, all the wonderful stuff you're doing. Dan, how can people find out more about your team and the services that are being provided over there?
Well, you can start by listening or reading to our lending update, a little bit about what we have to say.
That's right.
You can find us on our website, boejax.com. Give us a call, 904-992-1000. We're on social media, Instagram, boejax, Bank of England Mortgage. So however you want to find us, please find us. We'd love to talk to you.
Yeah, and if you're outside the area, go to boemortgage.com. Check it out. We've got offices all over the country here that'd love to help you and kind of participate in your new purchase or refinance of your home or investment property that you're looking to buy. Till then, check us out. Share this podcast. If you like what you're hearing, please 5-star review it. Leave a comment. Go to YouTube. Leave a comment. Subscribe to our channel there at What's Your One More with the number 1, or on our socials at What's Your One More with the number 1. Till then, we'll see you guys on the next episode. Dan, thanks again for being on the show.
Yes, sir.
I got one more shot, I'm gonna make it. One more chance, I'm gonna take it. I meant it when I said it, now it's time for me to do it. I got one life to live, so I put them all into it, yeah.